Welcome back, everyone. I hope you had a nice, relaxing break. Really excited for this panel, which is going to be focusing on climate change ETFs. We've also got a poll going on at the moment, so do take part in that. So if I could bring on my colleague, George, who will be hosting this panel. Hope you're well, George. Over to you, sir.
Thank you very much, Tom. Yeah, welcome, everyone. Hope you had a good networking break there. I am George Geddes, Senior Writer here at ETS Stream. And in the second panel discussion of this afternoon, we'll be touching on something which has already been mentioned a couple of times this afternoon, which is the focus on climate-focused ETFs, which have really come about over the summer this year. This is looking at the climate transition benchmarks and the Paris-aligned benchmarks, which has been launched by the European Commission. And we've obviously seen a lot of indices and ETF providers launching products with these sorts of labels. Over the summer, we've seen S&P launching 8 indices, MSCI have launched a range of 8 indices, and stocks have also launched 12 CTB and PAB indices. Joining me today, we have quite a well-rounded panel to cover all aspects of this launch and trend this year. So if I could just introduce Rafaela Lennox, Vice President and Senior ETF Product Specialist at Franklin Templeton, Elena Filipova, Global Head of ESG Proposition at Refinitiv and also member of the EU Technical Expert Group. And finally, Matt Brennan, Head of Passive Portfolios at AJ Bell. Just a quick reminder for everyone, please do get your questions in and do complete the poll, as we'll be coming to that towards the end of this discussion. Coming to you first here, Elena, just being part of the technical expert group, could you just provide some background on the launch of these benchmarks and kind of give a bit of reasoning for the launch and the main differences between the two benchmarks?
Thank you, George, and good afternoon, everyone. I hope you can hear me okay.
All good.
Great. So just to kick off, I think, broadly speaking, it's important to remind ourselves that the European Green Deal is the European Union response to the climate and environmental challenges that our generation is facing, and it has a definitive task to overcome. It's a new growth strategy that aims to transform the EU into a fair and prosperous society with modern, resource-efficient and competitive economy, where there are no net emissions by 2050, where the environment and health of citizens is protected, and where economic growth is decoupled from resource use. And the private sector has a critical role to play, as it will be providing the bulk of the sustainable investing in the next decade to finance that transition. And therefore, the sector requires very clear long-term signals, tools, and data to guide investors to sustainable assets. So the 2018 Commission Action Plan on Sustainable Finance plays a very important role in driving this agenda forward. Benchmarks, as we know, are critical tools in capital markets in multiple ways, and thus regulatory guidance on climate benchmarks is very much needed to facilitate the inflow of capital into green assets and limit the risk of greenwashing. So just to summarize, the amendments of the BMR regulation set quite high level of ambition by introducing firstly, the 2 climate benchmarks aimed at reallocating capital towards low carbon and climate resilient economy, as mentioned, the climate transition benchmark and the Paris-aligned benchmarks, as well as ESG disclosures for all benchmarks, excluding interest rates and currencies, against which we know €1 trillion in assets are managed. And this transparency will provide clarity on the ESG profiles and the degree of alignment with the decarbonization goals of the Paris Climate Agreement. Just quickly to clarify kind of the 2 types of benchmarks, CTB labeled benchmarks are those where the underlying assets are selected, weighted, or excluded in such a way that the resulting benchmark portfolio is on a decarbonization trajectory, but it's also constructed in accordance with the minimum standards laid down in the delegated acts. And it's important to flag that the delegated act scrutiny period of the Parliament and Council ended this week, and next week it's expected that they will be published in official journal. And the Paris-aligned benchmarks are those where the underlying assets are selected in such a manner that the resulting benchmark portfolio greenhouse gas emissions are aligned with the long-term global warming targets of the Paris Agreement, and of course comply with the minimum standards as set down in the delegated acts.
Perfect. Coming to you, Raphael, obviously Franklin Templeton's launched two PAB labelled ETFs early this year. Could you just kind of explain those products that you've brought to market, and also what you had to do to basically bring these products to market? What have the ETF issuers and index providers been needing to do to become compliant with these labels?
Sure. So we saw from speaking with our clients how much climate change is clear on their agenda. So this is from the EU Sustainable Action Plan, TCFD reporting requirements they have. In the UK alone, obviously, we've seen Rishi Sunak's recent announcements on mandatory company climate risk disclosures, as well as the United Nations Climate Change Conference in Glasgow happening next year. So there's a much more acknowledgement that climate change risks, both physical and transitional risks, will impact portfolio returns. A company's business model may not even be relevant in 5 years' time. So we wanted to create an ETF that would not just be a kind of a pure play climate solution, which there are quite a lot of environmental strategies like that out there in the market, but also be a sustainable core solution for investors. So looking to be able to reduce climate change risks within the portfolio, but also at the same time being able to access those opportunities in the low carbon transition. So at the time when we started looking at what kind of indices were out in the market, most of the ones that were out there were very much the kind of typical old style exclusionary indices that were just, let's say, excluding oil companies and fossil fuels. Whereas at that time, we started seeing the first results coming out of the primary consultation from the TEG on the EU climate benchmarks. And speaking with our investors, they were it was great that there was going to be good consistency and comparability within the market. So it's the first time I have seen a regulator come out with an index methodology. And actually, because they have come out with this index methodology, it means that you had all of this great research happening within the different index providers, all with the same common goal, creating these indices that were aligning with the Paris Agreement or with the transition benchmark, that were making sure they were getting all of this climate data, because it's a lot of very sophisticated climate data in working out the alignment of all of these companies to a 1.5 degrees or 2 degrees scenario. So we partnered with S&P on the S&P 500 Paris Aligned Climate Index. We see this as a core sustainable allocation. So we really wanted to look at the benchmarks that were most relevant to our investors. And with S&P, S&P 500 for the US is obviously the key benchmark. And also to make sure that they had, sufficient resources to be able to do these indices well, they have partnered with Trucost. So obviously S&P owned Trucost, who are the climate data specialists. And then on the European equity side, we worked with stocks. So again, we're looking at the Stocks Europe 600 index, again, key European equity benchmark for investors. And they have been working with ISS on all of this climate data. So it's really exciting that we're actually able to provide an ETF solution that is aligned to the Paris Agreement. And a lot of our clients were very keen to make sure that they did get the Paris aligned solution. We did actually look at the transition benchmarks initially, but for all the clients that we spoke to, they really wanted the higher ambition of the Paris Agreement. And actually being able to have a portfolio that is aligned and is looking at this from the 1.5 degrees, 2 degrees scenario, and looking at all key stocks and seeing how they are aligned was very, very exciting to be involved in, and we're very happy.
Definitely. Just moving to the investor perspective, Matt, how have you what has been your perspective of these climate products that have come to market? Have they come into your remit? And obviously, AJ Bell's done a lot within the ESG space recently. So obviously, it's quite a lot to be covering here. So could you just kind of touch on your experiences within these new products coming to market?
Yeah, I guess the interesting thing for AJ Bell is we have a direct consumer platform as well as a financial advisor platform. And I think the reaction is different on both sides. So if we start with the direct consumer platform, when bringing general ESG products to the market, it's really been the climate element that's resonated the most, is the easiest to explain, is obviously as others have touched on, is kind of very topical with some of the other areas. So for example, demonstrating the carbon impact of a switching investments seems to be very easy for people to understand. And I guess given both the Paris aligned and the transition benchmarks have those initial targets plus ongoing targets, makes it very easy to bring that message that the climate benchmarks are making a change. On the other side, if we move to the advisor side, actually it's almost the other way around. We're seeing much less demand on the advisor side, and what we tend to find on the advisor side is there's a portion of financial advisors really switched on this area, whereas a large part of the market is regulation driven. So the analogy I like to give is MiFID II. So before MiFID II came in, no one cared about transaction costs, even though people were going on about it for the 2-3 years before it came in. As soon as it comes in, that's all anyone looks at. I think it's similar here. So if you look at two pieces of regulation, so the sustainable finance disclosure regulation, which obviously looks like it's going to be delayed in the UK, and then other regulations such as retirement pathways, which both have a need to integrate ESG as part of that process, will really drive people towards these sorts of solutions. So as you say, we're seeing a portion of the market that's aware of that regulation, but I think there was a recent survey by Square Miles said that less than 50% of financial advisors were even aware this regulation was coming in. So I think getting the product ready is the right idea, but the amount of time for that to actually get penetrated into the financial advice market as a mass product might just be a bit of a slower burner.
I mean, it's been quite interesting seeing obviously the ESG developing over the last few years and how quickly these climate ranges came to market. I think it's quite interesting, Rafaela, if you could kind of explain how these ranges differ from typical ESG products, and then also what sort of client are they being directed at?
Yeah, yeah. I mean, it's interesting the point Matt was making. So, for some institutional investors, they are very, very knowledgeable about exactly what's going on in the climate space and in the regulatory space specifically, for climate change risk disclosures. But obviously, as you move down the tiers, it's more of an education for a lot of investors. But what we generally find is most people, they're at least aware of the MiFID II sustainability requirements as well as the EU SFDR disclosures. And most people are quite welcome to get this education in these products, which is usually what it is when you first introduce them. What I would say is different to these is that, I mean, if you go back to the evolution of ESG indices, they started off being kind of the standard indices, X controversial weapons, X a couple of different value-based exclusions. Then they kind of came on to being kind of more of the best-in-class indexes that were out there. So looking at best-in-class companies within different sectors from ESG criteria. Well, what's made this completely different is this is about reducing risk, but it's also about accessing the opportunities in the low carbon transition and actually looking at measurable impacts. So whereas investors before were quite happy to just look at something like, okay, these are the ESG scores, they're better than the parent, tick the box, happy. These days, actually, people want much more measurable impacts than that. So if you have something which says, actually, this is a 1.5 degrees aligned portfolio, or this is a 2 degrees aligned portfolio, this is stuff that is much more tangible to investors these days. And I see that as something beyond these benchmarks. I see that I do get involved in active funds as well. And we see so much more stress testing getting involved at the moment. You know, stress testing, carbon taxes are happening all around the world at the moment. Stress testing your portfolio as to what would happen if carbon taxes were to rise, they were to be at a certain level, and what would happen to your portfolio in your stocks if they're exposed to a lot of energy stocks, which have a lot of more stranded risk assets, risk in their portfolios. So it's getting quite sophisticated how people are looking at their portfolios from a climate change perspective. So what's different here is this is a climate focused strategy, but at the same time, by ensuring that it's covering the broader ESG criteria, such as excluding companies that are involved in tobacco, that are involved in controversial weapons, that any companies that are deemed to be UN Global Compact violators, you still are able to get a core sustainable solution. So I think it's kind of the conversation has moved a bit more from ESG into sustainability, and climate change is a huge focus of sustainability.
Very interesting. Just kind of moving back to the benchmark labels that were launched by the European Commission. Come to you, Elena. Could you just kind of clarify some potential skepticisms and potential issues that were kind of voiced when they first came to market, particularly around the scope 1, 2, and 3 data reporting and data reporting in general, about the difficulties that some of the smaller companies wouldn't be able to fully report? Would you be able to kind of touch on these a little bit more and give a bit more detail?
Yes, and I would certainly not be fair if I didn't acknowledge the concerns around data, and I would probably say data completeness a lot rather than data quality. And that has been discussed at length between the technical expert group members and European regulators. We also provided a number of recommendations for the market on how to solve for and overcome the data gaps that exist with current reporting that we see available in the market. But I think on a positive note, it's important to flag that there are a lot of different initiatives, both led by the public and the private sectors, to overcome this hurdle and mandate transparency and data availability. We, of course, expect to get the NFRD changes early next year, and potentially that will mandate disclosure by companies of different sizes, including breaking down the emissions data by different scopes, as well as other industry-led initiatives to improve transparency and harmonization of reporting standards. I believe all of these initiatives are going to help us work with complete and reported data very quickly. And until then, many specialized firms and data providers have been using and building estimate models to close those gaps across all types of emissions, direct and indirect, including Scope 3 emissions, to then enable the implementation of such climate investment strategies. And I think the pure fact that so many CTBs and PABs were launched in the last couple of months, even many were launched before the law was released, is a pure testament that the data necessary to fulfill the requirements of the benchmarks certainly exists in the market and can be utilized very effectively to generate and create very effective products and strategies.
Kind of following on from that, Raphael, I know you mentioned that you worked with S&P and stocks in terms of index providers. How are they having to adapt to this here?
Yeah, I mean, I'm very impressed with the level of data that has been around to support these. So seeing both the analysis from Trucost as well as ISS, you're looking at companies' carbon emissions, their scope 1, scope 2, and scope 3. The legislation didn't dictate it for the next 4 years on scope 3, but most are starting with scope 3 initially as well. There's also independently assessed science-based targets that many companies, particularly in Europe, have already signed up for, so they're able to look at those too. Both of these companies are also looking at all of the climate policies that each company have. So what they have in place from their carbon efficiency, and what they have in place across their supply chains. And it's very impressive what they can create, and combining all of this to determine, basically in an index, you're going to overweight those companies that are deemed to be climate leaders, and those companies that are deemed to be climate laggards are basically underweight through the index methodology, through the 50% relative decarbonization requirement that an index must have relative to its parent, and also this absolute 7% greenhouse gas reduction that you must have annually within the portfolio. And that's amazing. I mean, I haven't seen portfolios before that can actually claim to have a 7% annual decrease in greenhouse gases. And that's obviously lining up with the IPCC goals to obviously make sure that we have global warming limited to 1.5 degrees.
Yeah, definitely. Matt, coming to you here, do you think these products will be quite quickly adopted by the investment side here, or do you think there's going to be a bit of time needed for more products to come to the market to kind of create that wider pool for them to choose from?
Yeah, I guess there's 3 areas that we like to go on, 3 C's, I guess, cost, choice, and I guess the communication, the education side of it. So I think from a cost point of view, it's really good to see that products coming to the market are very reasonably priced. Not this isn't a product plug for Franklin, but obviously the 2 that they brought in the summer, it's good to see sort of not a significant premium above. So in the past, that's been a barrier, certainly for ESG. When products have come at 20-30 basis points higher than the standard, that's always been off-putting. I guess the next point would be choice, as I mentioned. So at the moment, building a whole portfolio with Paris-aligned benchmarks is not possible. You've got European and you've got sort of US exposure, but Asia, UK, for example, very few choices in terms of how to do that. So you end up with a bit of a pick and mix portfolio, and therefore it's harder to sell that as a proposition. And then I guess the third part is the education or the communication element. So I've obviously, in anticipation of today, I was speaking to S&P and asked for a summary of their benchmark, and they very kindly sent me a 94-page summary. So I guess really, as a user of these, they're so much more complex in terms of rules and the way they work than a standard portfolio, and even a step up from ESG. I think the outcome is really, really good, as both Rafa and Elena have touched on. But as a user, that journey for implementation will be slower. And maybe to give you an example, to launching our responsible fund, which is more of a standard ESG fund, that's kind of been an 18-month journey from me writing an article last year about how complex all the naming is in that part. And obviously it's taken us 18 months to get comfortable with that. If you move this a step on and make it even more complex, then it just does take time for investors to make sure, as we've touched on, things like greenwashing costs, building that portfolio is a longer journey. So I would expect it to be a couple of years away for the likes of ourselves and our, I guess, other asset managers to really be able to fully embrace it rather than just using it as a satellite strategy.
Elena, coming to you here, is the purpose of these benchmarks to protect the investors such as Matt, or is it going to be also looking to encourage companies to take these more sustainable initiatives and strategies and kind of be able to structure more assets to be able to support them?
Yeah, I mean, there are four main objectives of the climate benchmarks. So the first is to allow a significant level of comparability, and that's critically important. Comparability of climate benchmarks, while at the same time leaving enough flexibility for the benchmark administrators to design their individual methodologies, because this field is quite in its infancy stage, and innovation and flexibility is a key driver of adoption and moving this into mainstream investing decisions. The second objective is to provide investors with an appropriate tool to align with their investment strategy, because we've heard a lot that the demand in the market is there, but there is a problem with the supply. So that's exactly what it's solving for. The third is to increase transparency on investors' alignment with the needs of ambitious climate scenarios. And the fourth, equally important, of course, is to minimize the risk of greenwashing. Raphael mentioned one key point, and I would like to emphasize it as well. While benchmarks incorporating constraints related to climate and emissions so far have had primary focus on risk reduction, these two new climate benchmarks have a broader ambition. Investors using them not only intend to hedge against climate transition risk, of course, but they also have an ambition to direct their investments toward opportunities related to the energy transition. And that's quite important to be able to leverage both sides.
Very good. Just coming to you again, Rafaela. Obviously, it's worth mentioning about how ETFs are quite a benefit tool to use in terms of adopting these benchmark labels. Could you just kind of explain why the ETF wrapper is so compatible with these, and then also kind of touch on what the future could hold for this? Is there further development that could lead to either development across the geography exposures, or also about the asset classes as well?
Yeah, I mean, absolutely. I mean, the ETF wrapper is ideal for such a solution. You know, ETFs provide investors with the benefits of liquidity, low cost, and ease of access. And this is an area which is, you know, quite challenging to do from a portfolio management perspective, but you can create a fully Paris-aligned core solution for investors. So this is, you know, ideal for the ETF wrapper. And again, I mean, when it comes down to it, an ETF is a precision investment tool to help investors to implement their views. So if they want to align their investments to the low climate and the low carbon transition, they are able to do this with one simple trade. If we look about some of the challenges that Matt was talking about as well, yeah, I mean, as the moment, yes, it's more of a kind of large cap to mid cap kind of play at the moment. I mean, for smaller companies, this will be slightly harder for them to have given enough transparency on their climate profiles and ambitions to be able to qualify. However, at the same time, you know, this is the trajectory. We saw with Rishi Sunak announcing that companies are going to have to announce their climate risk, are going to have to disclose their climate change risks. And this is something that smaller companies are going to get more and more help with in the future. Also, from a geographical point of view, there are some areas of the world that are obviously taking climate change a bit more seriously and doing more. So whereas obviously Europe is leading the way there, US is doing well from a disclosure perspective, but obviously is a bit behind Europe. And then in some parts of Asia, it can be a bit tricky from a disclosure perspective as well. So some of these things will have to naturally evolve. Again, you can look at this from the fixed income side, so looking at different asset classes. And that's something, you know, which is quite interesting. You have to more stay at the issuer level, because obviously with most bonds, they will have expired by 2050. You know, most bonds that are issued have a lower maturity than the requirements of the 2050. But at the same time, we expect to see a lot more developments there on the fixed income side too.
That's good to hear. Coming to you, Matt, obviously We've kind of touched on your focus on ESG over the last 12 to 18 months. What developments would you like to see? Are you currently in a bit of a predicament, sticky situation where you have to kind of pick between ESG or climate, or is this something you'd like to see kind of come into the market here?
Yeah, I think it's an interesting one because, as you say, there has been this new, almost as you described, a new breed of ETFs, which are climate ETFs. And I guess, you look at these benchmarks and there is some ESG integration, some exclusions, but it still does feel like a choice of you either have to prioritize, I guess, your impact on the climate or looking at more societal and, kind of governance issues. So I think in the long term, it would be great if there was a way that, you could almost have an out the box that did everything. Obviously, when it comes to index construction, at some point it becomes impossible, given, I guess, you need to have a set of rules and it needs to be diversified. But what would be really useful is, kind of, and I think the way that these ones have come out of the regulator is good because it creates this kind of a bit more consistency, because that's always really been the challenge for us, is that one provider excludes something, someone else uses Sustainalytics, someone else uses MSCI, someone's used, as soon as you start getting these regulator driven benchmarks that are more holistic in nature, that's much easier for us as a user to be able to get behind and understand. So I think, what will we like to see, as you say, kind of, I guess, coalescence, further education, and more product, and really those three things, would be great. And, our new fund we've just launched, which was responsible ESG in the first instance, we've kind of said there's always that ability to pivot in the future. So if you've got products that were suitable, then that's kind of where we stand, looking to change our starting point as this continues to evolve.
Very good. I am conscious now that we are just approaching the end of this discussion here. We did obviously have the poll running just over the networking break in the beginning of this discussion, which I think we should be getting the results come to screen now. And obviously, so we asked whether the viewers currently considering climate change factors into their portfolio, which shows 60% did say yes. I guess it's quite promising to see how many investors are incorporating it, but also quite good from your perspective there, Rafaela, to be able to see there are potential new targets there to be able to put assets towards your ETFs. Is that much of a surprise to you?
No, not really. I mean, with climate change being so much on the agenda and so much a focus to all investor types these days and to all of us, on the news, the media, everywhere. It doesn't surprise me, no.
Perfect. Well, that looks like that will just be about all time we have here. Just want to say thank you to all of the panelists for joining and discussing the very interesting topic of climate change ETFs. I think we're going to be bringing on Tom now just to lead on to the closing presentation.
Cheers, George. Great stuff, guys. Yep. Just closing keynote to go now.